Good day to all. My name is 𝗪𝘆𝘀, iFAST Research Analyst. In the dynamic landscape of global equities, the third quarter of 2023 witnessed a notable retracement following a robust performance in the preceding quarter. The MSCI ACWI index, when measured in SGD terms, experienced a modest decline of -2.3%. Turning our attention to Malaysia, the potential for renewed confidence in the equity market hinges on key factors such as political stability, transparent monetary and fiscal policies, and compelling valuations. The prospect of a stable political environment and well-defined economic strategies could serve as catalysts for revitalizing investor trust in Malaysia's equity landscape. In Singapore, a promising narrative unfolds with the anticipated resurgence in export growth and a recovery in the semiconductor industry. These factors, coupled with anticipated earnings growth within the financial sector, position Singapore's equity market on an upward trajectory. It also serves as the bridge between the East and the West as international companies set up their regional hubs here. Next up, the Japanese equity market may have pulled back, but it still emerges as a standout favourite in the equity market arena, supported by a confluence of positive indicators. Improvements in corporate governance, expanding profit margins, robust earnings growth, and attractive valuations relative to other developed market peers collectively contribute to Japan's appeal. Meanwhile, South Korea presents a unique narrative, with signs pointing toward the potential end of the semiconductor down cycle. Given South Korea's significant reliance on exports and the manufacturing sector, a recovery in the chip industry could serve as a powerful catalyst, propelling the country's economy forward. To get the full analysis, scan the QR code or click on the link in the description below. Next up, 𝗪𝘀 will talk about semiconductor industry. Over to you, 𝗪𝘀.
Hi everyone, my name is 𝗪𝘀 and I'm with the research team at iFAST. The semiconductor industry, a perennial driver of technological advancement, finds itself at a critical juncture catalyzed by the rapid adoption of artificial intelligence. And despite the current down cycle, our strategic analysis indicates that the semiconductor sector is poised for a remarkable comeback, with the potential for quarterly sales growth to soar as much as 40% by the second quarter of 2025. We believe that the industry is once again at a pivotal turning point thanks to the rapid adoption of AI, which should drive a massive structural increase in demand for chips. Chipmakers, in our assessment, have somewhat underestimated the transformative impact AI is poised to have on long-term chip demand. Looking ahead, we expect the sector's propensity to make excessive adjustments to production levels to contribute to significantly higher sales numbers in the future. Moreover, beyond the intricacies of the inventory cycle, other macroeconomic factors come into play. Base effects, coupled with substantial incentives dispersed by governments globally, are set to elevate the industry's supply side. This in turn is expected to fuel an upward trajectory in sales growth as the burgeoning demand for semiconductor technology continues its ascent. And in light of these compelling factors, we are excited to upgrade our rating for the semiconductor industry from a solid 2.5 stars neutral to a more bullish 3 stars attractive. As a tangible expression of our confidence, we have set a target price of $182 for the VanEck Vectors Semiconductor ETF, which also represents an upside potential of nearly 30%. So navigating this cyclical yet constantly evolving landscape of the semiconductor industry demands a nuanced investment approach. Investors are advised to adopt a longer time horizon, recognizing the cyclical nature of the semiconductor industry and strategically leverage down cycles as opportunities to build positions. To get a full analysis, scan the QR code or click on the link in the description below. Next up, Colin will share more about Westpac. Over to you, Colin.
Hi, my name is Colin, Portfolio Manager at iFAST Bond Research Team. Today I'll be sharing an idea from Westpac Banking Corporation, one of Australia's largest and oldest banking institutions. Westpac has exhibited a commendable financial performance in both the first half of this year and the third quarter as well. Notably, the group experienced growth in net profit, a success attributed to robust net interest income. This positive outcome underscores Westpac's resilience in navigating a tighter financial condition and slower economic growth. Despite the achievements, Westpac anticipates a decline in net profit after tax for fiscal year 2023. However, the outlook remains optimistic as we expect a potential rebound in fiscal year 2024. The group itself is also embarking on a new strategic phase, which prioritizes growth and increasing shareholders' return. One of the key strengths contributing to Westpac's overall stability is its credit profile, which continues to remain robust. The group maintains a healthy capital and liquidity position. The group's CET1 capital ratio was 11.9% in the third quarter this year, above the regulatory minimum and the group's target as well. On an internationalized basis, the ratio stands at 17.9%, which is comparably high amongst global peers. Furthermore, Westpac was able to maintain high levels of liquidity as high-quality liquid assets grew over the quarter. The quarterly average liquidity coverage ratio, LCR in short, improved to 138%, while the net stable funding ratio, NSFR in short, was 118%. Both ratios showed large buffers to the 100% minimum regulatory requirements. Overall, Westpac's credit profile remains healthy with a strong capital and liquidity position as well as resilient asset quality. We also find the group to be sufficiently provisioned. While we see little area of risk for the group, the Australian mortgage loan book remains an area that we are watching closely. Among Westpac's AUD Tier 2 subordinated bonds, we prefer the 4.334% 2029 bond. We like the short remaining years to call, which is accompanied by an attractive yield to call. In the event of a non-call, we also find the yield to maturity attractive for a medium tenor AUD bank bond. To get the full analysis, scan the QR code or click on the link in the description below. That wraps up for the sharing of this week. Catch us again next week for more investment ideas and updates.